Wall Street is on track to have its worst day of the year. As a matter of fact, the worst day since last October. What's going on? So many different things. Let's turn to Dan Ives. He's the managing director of equity research at Wedbush Securities. So, coronavirus fears, we got the bond market flashing a recession signal again, we got weak data, weak earnings. What do you make of this market?
Look, I think right now, especially in tech, you've had a strong earnings season, but it's really the coronavirus. That's been the worry. The flights getting shut off to China, really worries about the tech supply chain. Tech companies as well as anyone that's exposed to Chinese consumer, I think that's really kind of put gasoline in the fire right now, and you're seeing a sell-off accordingly.
So you focus on the technology sector. I'm wondering from you, which companies are the most vulnerable if this coronavirus thing goes on for a long time in terms of being exposed by their supply chain, and then on the flip side, being exposed to the Chinese consumer?
Yeah, from a tech perspective, it's semis. That's why you see semi stocks really leading tech down today. And I think that's one from a supply chain. You look at names like Intel, AMD, NVIDIA, Micron, obviously those are most exposed. You look at a name like Apple in terms of not just on manufacturing, in terms of Foxconn, but also consumer perspective, they're highly exposed. And then Tesla as well in terms of just Giga 3 in Shanghai. But I do think right now the bark's worse than the bite. I think it is contained, but nonetheless right now you're seeing, especially going into the weekend, a lot of worries, and you're definitely seeing investors hit the sell signal.
So when you see this kind of erosion in the market, are you seeing it as a buy signal or a signal to wait and hold?
To me, and it's been our thesis for the last few years, a bright green buy signal. Because anytime these macro, world's ending type events, it's the opportunity to own these FANG names, own tech, because in my opinion, it's a contained issue. And even if it sort of goes into March and maybe moves some of the units from call it March to June, it's a timing issue. So to me right now, you're a buyer of tech names, and I think these macro events, they create the opportunities to own tech names cheaper.
So let's talk about one stock that's doing well despite what we're seeing in the overall market is Amazon. They came out with their results, blockbuster results. Look like they're able to manage one-day shipping without costs getting out of control. Looks like we might see them close above $1 trillion market cap for the first time ever. So what's your view on Amazon?
Yeah, that was a Mahomes-like performance in terms of what we saw from Amazon last night. Specifically, not just on the e-commerce side, but on the cloud side. Right now, they're continuing to build that significant moat on Prime membership. That moat right now is really what's differentiating them. And I think you saw numbers that handily beat expectations. The profitability on AWS, that's the 1-2 punch right now. E-commerce and cloud, $1 trillion plus market cap. We continue to think Amazon's a stock that goes 2,500. FANG names continue to be strong. Apple and Amazon leading the charge. This was a huge shot in the arm for tech bulls, despite some of the noise and some of the softness you're seeing today across the tape.
All right, so IBM was this week. Amazon was this week. Let's look ahead to next week. We hear from Alphabet, the parent of Google. According to Refinitiv IBES, we're looking for an EPS of $12.53 a share. Sales coming at somewhere between $46–47 billion. Give me your outlook for what you are looking for in terms of what you want to hear from Alphabet.
Sure, I think it's going to be a strong quarter. I think monetization on the search continues to be there. And they'll beat estimates in terms of expectations. But I think the big thing with Sundar taking charge on Alphabet, it's cloud. If you look right now for Google, that's the missing piece. Search, monetization, they continue to own. The big piece to the valuation of the story is cloud. Amazon's been massively successful. Microsoft, you saw it this week. I think that's going to be the big focus, doubling down on cloud, strategically how successful they're going to be there. There could be some acquisitions there. So then that's going to be a big focus outside of numbers in terms of cloud success from GCP and Google.
And what about costs? I mean, when we saw Facebook's results earlier this week, I mean, there was this concern about them having to spend more to deal with privacy issues and the whole regulatory scrutiny. Are you going to be looking closely at the costs at Alphabet for that too?
That's a balancing act. I mean, they're going to have to continue to plow investments, especially on some of the newer initiatives, as well as just the regulatory environment, what you're seeing there. But I think the big thing that you saw on Facebook that I don't think you'll see in Google was really some sub-growth miss and really disappointment on the top line. I think as long as Google, they continue to accelerate in terms of on the monetization side, then I think you're going to see a stock that goes higher. And it continues to be our view. FANG names go up another 25% this year. You look at the noise, fundamentally, I think Apple and Amazon just tip of the iceberg in terms of what we'll see for the rest of the year.
All right, great. There's the rundown on the tech sector for 2020. Dan Ives is the Managing Director of Equity Research at Wedbush Securities. I'm Conway G. Gittens, and this is Reuters.